Have you ever walked into a high-end luxury boutique, picked up a watch or a handbag, looked at the price tag, and immediately put it back down? We have all been there. It is a beautiful item, but the price just feels wrong. It feels inflated. But then imagine walking into that exact same store 6 months later. The same item is there. The craftsmanship hasn't changed. The leather is still premium. The brand is still prestigious. But the price tag is now slashed by 50%. Suddenly, that item is not just a purchase. It is an opportunity. You do not just buy it. You feel like a genius for buying it. Welcome back to Grow with Tony. Today we are going to apply that exact same logic to the stock market. We are moving away from the hype, away from the overvalued tech darlings that keep you up at night, and we are walking straight into the clearance aisle of the American economy. We are doing the ultimate deep dive into the Schwab U.S. Large Cap Value ETF, ticker symbol SCHV. Before we dive in, just a quick heads up. I am sharing my research and opinions here for educational purposes, not personalized financial advice, so please make sure to do your own due diligence before making any investment decisions. Now let's set the stage. Why are we talking about this specific ETF right now? We live in a financial world that is obsessed with growth. You open your newsfeed and it is all about artificial intelligence, microchips, and companies that are trading at 100 times their earnings. It is exciting, sure, but it is also terrifying. When you buy a stock that is priced for perfection, everything has to go right. If they miss their earnings by a penny, the stock crashes. That is the price of admission for growth stocks. But there is another way, a quieter way, a way that has built dynasties like the one Warren Buffett sits on top of. It is called value investing, and SCHV is arguably one of the most efficient vehicles to transport you into this world. So let's tear this ETF apart and look at the engine. What is SCHV actually doing with your money? SCHV tracks the Dow Jones U.S. Large Cap Value Total Stock Market Index. That is a very long name, so let's unpack what it actually means because the secret sauce is in the methodology. This isn't just a random collection of old companies. The index starts with the largest 750 companies in the U.S. stock market. Then, it filters them. It is like panning for gold. It takes these companies and runs them through a comprehensive screening process. It doesn't just look at one thing, it uses a 6-factor model to determine true value. They look at projected price-to-earnings ratios, trailing price-to-earnings, price-to-book ratios, and dividend yields, among others. It is a rigorous health check. They are essentially asking, is this company undervalued right now compared to how much money it actually makes? If a company scores high on these value metrics, it gets into the SCHV club. Currently, this ETF holds roughly 560 stocks. Think about that number for a second, over 550 companies. The number fluctuates quarterly as they rebalance, but the principle remains the same. You are not betting on one horse. You are betting on the entire stable of established, profitable American industry. Let's talk about the guts of this fund. What are you actually owning? A lot of people think value funds are just old banks and oil companies. While that is part of it, SCHV is smarter than that. Yes, the financial sector is a massive backbone of this fund. We are talking about the giants that facilitate the flow of money in the largest economy in the world. When interest rates are decent, these companies tend to be cash-printing machines. Then you have healthcare. This currently sits at approximately 12.7% of the portfolio. We are talking about powerhouses like Johnson & Johnson and Pfizer. Think about it. No matter what the economy does, no matter if there is a recession or a boom, people get sick. People need medicine. This makes the healthcare sector incredibly resilient. But here is where it gets interesting: technology. There is a myth that SCHV avoids tech. That is wrong. SCHV currently has about 15% exposure to technology, but it is not the hype-driven, zero-profit tech. It holds value tech, companies like Microsoft or others, when they trade at reasonable valuations relative to their earnings. So you are not missing out on the future, you are just buying the future at a discount. And let's not forget consumer staples and industrials. We are talking about Home Depot, Coca-Cola, and Chevron. Do you see the pattern here? These are solid companies, and I mean that as the highest compliment. These are companies, including those solid tech giants, that make things people need, not things people just want. They have real assets, real cash flow, and real history. Now let's address the elephant in the room, the fee-the expense ratio. This is where Charles Schwab really throws down the gauntlet. The expense ratio for SCHV is 0.04%. I need you to really understand how incredibly low that is. In the old days, if you went to a mutual fund manager, they might charge you 1%, but 0.04%, that is practically free. Let's do the math. If you invest $10,000 into SCHV, Schwab charges you $4 a year to manage it. $4, you cannot even buy a decent sandwich for $4 anymore. For that price, they rebalance the portfolio, they handle the dividends, and they give you diversification across over 500 stocks. It is arguably one of the best deals in the financial industry. Speaking of money, let's talk about dividends. Because SCHV focuses on value, it naturally selects companies that are mature and profitable. Currently, SCHV offers a dividend yield hovering around 1.9 to 2%. Compare that to the S&P 500, which sits around 1.2%. That is a significant difference. Of course, this yield fluctuates with the share price, but the gap is real. And here is the magic trick. If you do not need that cash right now, you turn on dividend reinvestment, or DRIP. It is a snowball effect that turns a small initial investment into an avalanche over 20 years. But I promised you a complete picture, and that includes the risks. We have to be honest about the downsides. SCHV is a value fund. That means it has less exposure to the high-flying growth stocks than the broader market. When the market goes into a frenzy over a new technology innovation, SCHV might look like it is moving slower. While the S&P 500 has about 30% in tech, SCHV has only about 15%. You might see the market rallying hard while SCHV is steady. That feeling is called FOMO, fear of missing out, and it is the hardest part of holding this ETF. You have to be patient. You have to understand that you are the tortoise in the race. Also, we have to talk about value traps. Value trap is a company that looks cheap because its stock price has fallen, but it has fallen for a very good reason. Maybe their business is dying. Since SCHV relies on mathematical models, it sometimes picks up these companies. However, because the fund holds nearly 560 companies, the risk of any single value trap destroying your portfolio is minimized by diversification. Now, how does SCHV compare to its rivals? You might have heard of VTV, the Vanguard Value ETF. VTV is the heavyweight champion. It is bigger and has more assets under management. But here is the thing, SCHV and VTV are almost identical twins. Their performance is highly correlated. VTV also charges an expense ratio of 0.04%. So SCHV isn't cheaper, they are tied for first place. Historically, SCHV often has a lower share price, meaning the cost to buy a single share is lower. In the past, this made it easier for small investors to buy in. However, I want to be fair. In today's world of fractional shares where you can buy a sliver of a stock for $5, this price difference matters much less than it used to. But for some, that lower entry price is still psychologically appealing. So who is this ETF actually for? It is for the realist. If you believe that trees don't grow to the sky and that eventually valuation matters, SCHV is for you. It is for the defensive investor. If you are nearing retirement and you cannot afford to have your portfolio drop 50% because a tech bubble burst, the heavy allocation to healthcare and stable industries in SCHV acts like a shock absorber. It won't stop the volatility completely, but it tends to be less volatile than a pure growth fund. And it is for the barbell strategist. Many investors like to have high-risk, high-reward stocks on one side and super stable, boring value stocks on the other. SCHV is the perfect heavy weight for the stable side of that barbell. Let's take a moment to look at the historical context. Value investing goes in cycles. There are decades where value beats growth and decades where growth beats value. We don't know what the next decade holds, but history tells us that paying a fair price for profitable companies is a strategy that never truly goes out of style. We have covered the index methodology, the updated sector breakdown, the fee structure, the dividend advantage, and the psychological battle of holding it. As we bring this deep dive to a close, I want to crystallize exactly what you should take away from this episode. You have learned that SCHV is not a get-rich-quick scheme, it is a stay-rich strategy. You have learned that for the price of a cup of coffee per year, you gain ownership in roughly 560 of America's most established corporations. You have learned that it balances sectors like financials and healthcare with a healthy 15% dose of value-priced technology. And most importantly, you have learned that while boring might not make for exciting dinner party conversation, boring is often what builds sustainable long-term wealth. Investing shouldn't be a thrill ride. It should be like watching paint dry or watching grass grow. If you want excitement, go to Las Vegas. If you want to build a future, look at the fundamentals. SCHV offers you a seat at the table with the titans of industry at a discount price. It is simple, it is efficient, and it is powerful. Thank you so much for spending this time with me on Grow with Tony. I hope this deep dive gave you the clarity you needed. If you found this breakdown helpful, please do me a massive favor. Smash that like button, hit subscribe, and ring that notification bell so you never miss an episode. And I want to hear from you. What ETF or financial topic should I tear apart next? Drop a comment below. Seriously, tell me what you want and I will get to work on it for you. But if you are happy just lurking, that is cool too. Until next time, keep your costs low, keep your standards high, and keep growing.